So the next point which is relevant and which has been provided in the UAE proposed law is that what about the unrealized gains or losses? Just to give you an example, what exactly is unrealized gains or losses? Suppose there is a person who bought a property on 1/1/2020 for 1 million dirhams. He continues to own it, and on 31/12/2024, let's say the value of this property is 1.5 million dirhams. So if you actually see, there is a gain that this person has. So if he sells the property, he gets this money and he earns a gain of how much? 500,000 dirhams. However, because he has not sold the property, the gains have not been realized. These are unrealized gains. These unrealized gains may actually be, under different accounting rules, be required to restate it. So let's say if this person had a balance sheet, and on balance sheet there was an asset of 1 million on the date of acquisition, the law may require them to restate this to 1.5 million. And the moment he does this, he has to book a gain of 500,000 in the profit and loss account. Now, because the profit and loss account is taken as the starting point for calculating the taxable income, the question which comes up is that should this gain be considered as income, and therefore it should be liable to corporate tax. This is the provision which we are going to now see. So what are unrealized gains? I think what I explained to you a little earlier explains it. That gain was in respect of a capital asset. Why? Because the asset was a building or a piece of real estate, as we spoke about. The same thing can also happen in respect of stocks. So you bought a stock when it was, let's say, AED 10 per unit. On 31st of December, it increased to AED 12 per unit. So basically, the question is again, will this 2 AED be offered to tax or not? So under the draft public consultation document, it has been provided that specific rules will be prepared under the UAE law to determine the tax treatment of unrealized gain or losses. Once the law is issued, then these things will be available. Rules would cover whether gain or loss is related to a capital item or revenue item. So the tax treatment of a capital item is generally different from a revenue item. Now, what do you mean by either of these two is something we will see in the next slide. But as a general rule, unrealized gain or capital item is not subjected to tax. Whereas this may not be necessarily true in respect of revenue items, but that's a general rule. Now, what is there under the UAE corporate law in respect of this is something, let's see. So the gains can be in the nature of capital. When are they considered as capital? When they have a long-term impact on business. So for example, an asset, a long-term capital asset might be a machinery. You purchase a machinery for 1 million dirhams. The value rises to 2 million dirhams. There is an unrealized gain of 1 million. Now, because the machinery is a long-term asset, therefore, the increase is a capital item. Second is a long-term loan. Now again, for example, there was a loan that was taken for 5 million dirhams. Now, because of certain reasons, the banks agree that, okay, instead of 5, you have to pay 4 million only. And there's a reduction in liability by 1 million. If the loan is restated, this 1 million may find its way to the profit and loss account. These are the items which have long-term impact, and therefore they are considered as capital items. The second one is a revenue item. Revenue item are the ones which are other than the capital item. For example, stock of goods. So basically, in case of stock of goods, there might be an increase or a decrease in the value of the stock. So how does the tax treatment for these two categories work? Generally, the unrealized gain on account of capital assets are not considered as a part of taxable income. And this is also what is suggested in the draft public consultation document. On the other hand, the unrealized gain on revenue items will be considered and taken into account while calculating the taxable income of the assessee. So if there are any revenue items due to which there is a gain which arises and it is booked in the profit and loss account, when calculating taxable income, it will not be excluded from the profit side, which means that there will be tax payable on this account. Of course, like I mentioned in the preceding slide, the detailed rules relating to this is something which is going to be issued, and therefore one will need to look out for those rules to figure out whether that income is taxable or otherwise.